A whole life policy can promise coverage for life and still leave you surprised by what it does not cover. Most people hear lifelong protection and assume everything is included. But permanent does not mean unlimited. Think of this fire as the policy. It can keep burning all night, but only if it is properly funded and protected. Whole life insurance usually combines three things: lifelong death benefit protection, predictable premiums, and cash value that develops over time. The main promise is the death benefit, the money paid to your beneficiaries when you die, as long as the policy is still in force. Unlike term insurance, this protection is not designed to end after 10, 20, or 30 years. Traditional whole life premiums are usually level, meaning they do not increase simply because you grow older. Some policies let you pay for 10 or 20 years and then stop paying while the coverage continues, but those payments are usually much higher. Cash value is the part that builds inside the policy, but it usually grows slowly in the early years. That value is governed by the contract. It is not a separate bank account, and it is not instantly available without conditions. One page shows guaranteed values. The other may show projected dividends or future growth that is not guaranteed. Those projections may improve the policy, but only the guaranteed column tells you what the contract must deliver. You may be able to borrow against cash value, but a policy loan is still a loan, and the insurer charges interest. If that loan remains unpaid, it can reduce what your beneficiaries receive. And if the loan grows too large, the policy may lapse, potentially creating both a coverage problem and a tax problem. Riders can add protection for disability, serious illness, children, or future purchases, but most are optional and usually cost extra. An accelerated death benefit may give you early access during a qualifying illness, but that money normally reduces the final death benefit. Here is where people make dangerous assumptions. Whole life insurance is not health insurance. It does not automatically pay hospital bills, routine treatment, or long-term care expenses. Chronic illness or long-term care benefits may be available through riders, but they come with definitions, eligibility rules, and trade-offs. Cash value is also not designed to behave like a stock portfolio. Its purpose is usually stability and guarantees, not maximum investment growth. Early claims can also face review. Policies commonly include a contestability period and a suicide exclusion during the first years. Before buying, check the guaranteed death benefit, premium schedule, cash value, surrender charges, loan terms, and every rider definition. To compare policies, guarantees, and costs side by side, visit Quote Maestro today.